Greece, a nation that has navigated treacherous economic waters over the past decade, found itself at another important juncture as 2025 unfolded. The robust upward trajectory that characterized the post-pandemic rebound started to exhibit a more tempered pace, signaling a new phase of economic adjustment. The initial months of 2025 were therefore critical in assessing the resilience of the Greek economy and the effectiveness of its ongoing structural reforms in the face of emerging challenges. While the Greek GDP expanded by a respectable 2.4% year-on-year in the third quarter of 2024, quarter-on-quarter, GDP growth slowed to 0.3% in Q3 2024. This slowdown suggested that while the annual picture still reflected positive momentum, the underlying rate of expansion was losing some of its earlier vigor. Economists and policymakers began to closely monitor incoming data for signs of whether this slowdown was a temporary blip or the beginning of a more sustained period of lower growth. The challenge for Greece was to diversify its economic base further and to ensure that growth was not only maintained but also became more broad-based and resilient to external shocks. Looking ahead into 2025, various institutions offered their projections for Greece's economic trajectory, providing a framework for understanding the potential challenges and opportunities. The Bank of Greece projected GDP growth to be 2.5% for 2024 and maintain that same pace at 2.5% for 2025. However, international bodies presented slightly more conservative views. The International Monetary Fund, or IMF, for instance, projected that the Greek economy would grow by 2.1% in 2025. This divergence in projections underscored the inherent uncertainties in economic forecasting, especially in a global environment marked by geopolitical tensions and shifting trade patterns. Beyond the immediate 2025 horizon, the IMF also pointed to more significant medium-term challenges. It forecasted that Greece's growth could slow to around 1.25% in the medium term. Addressing these long-term headwinds would require comprehensive reforms that go beyond immediate fiscal measures, touching upon education, innovation, and the overall business environment. Several external risks loomed over the 2025 projections, including weakening economic activity in the broader euro area, and potential competitiveness losses due to higher unit labor costs. Inflationary pressures, a global concern for the past few years, continued to be a significant factor in Greece's economic equation through late 2024 and into early 2025. In December 2024, the annual inflation rate saw an uptick, rising to 2.6%. Despite this late-year rise, the annual average inflation for 2024 stood at 2.7%. As 2025 commenced, the expectation was for a continued, albeit gradual, easing of inflationary pressures. Projections for the first quarter of 2025 indicated that inflation was likely to trend towards the 2% mark by the end of March. In response to the evolving inflation landscape across the eurozone, the European Central Bank's monetary policy stance remained a critical determinant for Greece's financial conditions. By December 2024, the ECB's benchmark interest rate applicable to Greece had been adjusted to 3.15%. This monetary policy easing, however slight, provided some relief to borrowers and could potentially support investment activity if continued. For Greece, lower borrowing costs would be beneficial for public finances, given its high debt levels, and could also encourage private sector investment. The Greek labor market in early 2025 presented a mixed picture, reflecting both progress and persistent challenges. The headline unemployment rate in March 2025 stood at 9%. This figure marked a slight but welcome decrease from the 9.4% recorded in March of the previous year, 2024. However, an unemployment rate of 9%, while lower than the crisis peaks, remained significantly above the eurozone average. A particularly acute concern within the Greek labor market continued to be the high rate of youth unemployment. For individuals under the age of 25, the unemployment rate in March 2025 was a staggering 25.2%. Examining broader employment metrics, the employment rate for the population aged 20 to 64 in 2023 was 67.4%. Efforts to improve this rate involved not only creating more jobs but also addressing issues such as skills mismatches, enhancing vocational training programs, and promoting labor market flexibility. Beyond the headline numbers, the Greek labor market faced several underlying challenges that influence these figures, including demographic headwinds and the need for upskilling and reskilling initiatives. Greece's public finances, long a focal point of international attention, continued to be an area of careful management and scrutiny in 2025. The debt-to-GDP ratio, a key indicator of a country's indebtedness, stood at a substantial 162% in 2024. While this figure had come down from its crisis-era peaks, it still positioned Greece as having one of the highest public debt burdens within the European Union. Despite the daunting headline figure, projections indicated a clear downward trajectory for the debt-to-GDP ratio. It was expected to decrease to 149% in 2025 and continue this path, potentially reaching 133.4% by the year 2028. Part of this strategy includes proactive debt management operations. The cornerstone of Greece's fiscal strategy remained its commitment to maintaining primary surpluses. The International Monetary Fund expected Greece's primary surplus to remain high, at around 2.5% of GDP in 2025. Complementing these efforts on the debt and deficit front, Greece also aimed to improve its external balance, with the IMF projecting that the country's current account deficit would narrow to below 4% of GDP over the medium term. The tourism sector, a traditional powerhouse of the Greek economy, presented a somewhat contradictory picture in early 2025, highlighting both its enduring appeal and its sensitivity to global economic shifts. For instance, arrivals of American tourists in the first quarter of 2025 increased by a notable 16%. However, this increase in visitor numbers did not directly translate into a proportional rise in tourism revenue, particularly from the American market. Data for March 2025 revealed a significant and concerning trend. Spending by American tourists fell by nearly 30% compared to March 2024. Several factors were attributed to this decline in spending by typically high-value American tourists, including economic uncertainty within the United States and a weaker US dollar relative to the euro. Compounding this, higher overall costs within Europe may have encouraged tourists to adopt more budget-conscious travel styles. The implications of such trends in tourism spending are significant for Greece. A sustained period of lower per-tourist spending, even if arrival numbers remain robust, could dampen the overall economic impact of the sector. This underscores the importance for Greece not only to attract visitors, but also to enhance the value proposition, encourage longer stays, and promote diverse tourism offerings. In conclusion, Greece's economic journey in 2025 is characterized by a landscape of moderated growth, ongoing fiscal consolidation, and the critical need to address persistent structural challenges. The slowdown in GDP expansion from the more vigorous pace of previous recovery years serves as a reminder that sustainable prosperity is not guaranteed but must be diligently cultivated. Key economic indicators paint a picture of an economy that has made significant strides but still faces considerable headwinds. The path to sustained progress for Greece hinges critically on the unwavering implementation of structural reforms and the maintenance of fiscal prudence. Attracting quality, sustainable investment remains a paramount objective. Enhancing competitiveness is not a one-time task but an ongoing process of adaptation and improvement in a rapidly changing global economy. Ultimately, Greece stands at a crucial point, and its ability to navigate the current economic narrows and achieve a future of robust and inclusive growth will depend on its steadfast commitment to transforming its economic model. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.